Content is intended to provide accurate information, however, is not intended as financial, tax, or legal advice. Please consult a financial, legal, or tax professional for specific information regarding your individual situation. Opinions expressed and provided are for general informational purposes only and should not be considered a solicitation for the purchase or sale of any security.
Welcome to Game Plan for Retirement with Chris McIntire. McIntire Retirement Services, Northwest Ohio's retirement planning resource.
And welcome into the program. This is your Game Plan for Retirement with Northwestern Ohio's resource for a common sense approach to planning for our financial and retirement futures. He is president and founder of McIntire Retirement Services. Chris McIntire with us once again. Chris, welcome back in.
Hey, Peter, it's good to be with you, and I wish everybody out there a happy day here today.
Well, we are glad that you are with us, Chris, because we have seen a lot of nervousness, a lot of apprehension and angst because the market is once again showing volatility. It hates uncertainty. We got the election behind us, but coronavirus, I guess, really still in the news, very, very heated on what direction the numbers are going on that. So we have a lot of concerns globally, obviously, but more poignant, I think, for our listeners and viewers here on your Game Plan for Retirement. This is all affecting our money and our finances, Chris.
No question about it, Peter. We're seeing, the stimulus package got put on hold. So, we have all that election uncertainty, and then, add in the virus is just spiking all over the globe. And, Peter knows, folks, that, I do a lot of research looking on that, watching the vaccines, the antibody treatments, all that. I'm kind of a geek about that, looking for some opportunities, obviously. But in Spain, you're seeing lockdowns, in Germany and in Russia. So this isn't something that's, just here in the United States. And I know in election cycle, everybody's like, oh, it's just the virus. It's just the virus. It's like, guys, this thing is exploding all over the globe here. So, we're going to have to deal with this here, and it's going to bring some economic uncertainty. So, you could probably make an argument that, going into winter, do we, take a look at consumer staples? People are still going to need to go into Walmart, Target, Kroger, some of those big manufacturers, the things we need to get by no matter what's going on. We need some consumer staples. So, kind of back to your bellwether, type of stocks.
Yeah, Chris, well, the first go around and round, it seemed like during lockdowns, it was, oh, you unruly Americans, you can't follow orders and remain locked down. But it seems like more globally now, a lot of people are sort of ignoring those lockdown orders or bucking them a little bit. And so, managing this, containing it, is that even going to be possible at this point in time? And you're right, we have to get on with life. I mean, we've got requirements, we've got kids to feed, we've got jobs to go to. It's really hard to just shut the world down and let this thing pass over. And even if we do, the science is not conclusive on whether it would pass over us or not. And so it's here to remain. I think it's something that we're going to have to deal with. But again, Chris, more importantly, I think to our listener is, what do we do with our money in the meantime? Because it's affecting my forward financial progress. This is what we talk about on the radio program each and every week when we discuss risk. And I know you wanted to talk today about risk. What is risk? How much can we take? How do you quantify risk? How do you protect against risk? And that's really, I think, on topic for what we're seeing going on in the news cycle as well, Chris.
Yeah, absolutely. And we're going to be dealing with this, especially through the winter months when, hey, do I have a cold? Do I have the flu? Do I have the virus? So all of that uncertainty, Peter. And I would say that the most common concern that my clients have expressed to us is, what do we do around the election? Do we move into cash and then determine when to get back in? And, I'm an advocate of determining what your risk tolerance is, Peter. And as our biggest thing that we start off with building portfolios is determining the risk tolerance that clients or prospective clients have, and we have to update those forms right now. Every 3 years, we have to update what we call a risk profile for each individual client. So where is your stomach for downside movements? And, we certainly have seen some of that here recently. We've had some good numbers that came out in September for the economic activity, consumer goods, which are typically things that are built to last more than 3 years. So washing machines, that activity blew the numbers away in September. So there is always opportunity out there, but it is way too hard to say, I'm going to go into cash, and then after the election, I'm going to determine when to get back in. And, what day are you going to pick to do that, on a Tuesday or a Thursday, that type of thing. So you need to build a well-diversified portfolio that is in guidance with your overall risk tolerance. And Peter, how long we've been doing this radio show? 10 years or so anyway. And we have always been advocates of safe money strategies for clients to have an alternative to rely on when the market doesn't do the things you want to. And we've never changed that course.
Right. Now, up times, down times, sideways markets, up markets, down markets. It has been a consistent mantra of the radio program, Chris. And I think that you're right. Timing the market, inherently exceedingly difficult to do, because you have to time it right twice. When do you get in? When do you get out? When do you get out? When do you get in? If you miss either one of those sides, you've timed it incorrectly. And I think a lot of people had experienced a time where they did half of it correctly, but then missed the other half and then kicked themselves regretfully for the mistake that they ended up making there. And so, Chris, we have a long-term investment approach. Investing always needs to have a longer time horizon behind it, with the understanding that we are going to incur some risk. And most investors take that risk to get some return on their money, but we don't know the day that we're going to make that return or how much return we're going to make. And that's why we have to have a plan behind it to help us gauge the risk, gauge how much is appropriate, how much we should be taking, what our expectations are. And ladies and gentlemen, if you feel at all uneasy about your current plan, pick up the phone, give Chris McIntire a call. He can help you review and analyze that plan and expose the risks that you are taking, so you can be more informed and make better decisions about it. 800-868-1194, always the number to reach McIntire Retirement Services, 868-1194. That's 800-868-1194. But Chris, for each individual, the type of risks that they are taking and how much they should be taking is going to change.
Absolutely. And, we probably deal too much with the 24-hour news cycle, Peter, because, somebody sees something on the internet and they sell. Somebody sees something on the internet and they buy, instead of, understanding that, like Peter just got done saying, is that, buying stocks is a long-term type plan. And, so let's say you go into cash. Here's a good example. You go into cash around the election and you miss a lot of dividend payments that you would have gotten had you been invested in the market. And those dividend payments would have reinvested and bought stocks at lower prices. I mean, you give up dollar cost averaging when you do that. So, ducking into cash, what day do you get out? What day do you get in? And look, we get it, that this is a very unnerving time with a global pandemic. We've got obviously some civil strife here around the election that we, aren't used to seeing. And, there's probably been so much money spent on the election here this go round, where if they would have divvied that up to the average Americans, we wouldn't have missed a beat,
That alone could have been a boost to the economy and been that next round of stimulus.
Yeah, absolutely. Maybe buy stock in the advertising companies or something like that. But, it doesn't make it, it's still troubling for investors when they open up their statements, people that have just retired and they've just started to pull money out of their nest egg. And all of a sudden we hit 2020 here, or 2020. And what will 2021 bring? If we listen to Dr. Fauci, he's kind of our lead guy here, whether or not you read the tweets about him or not. But, he says, hey, it looks like good vaccine candidates here late November. So should get some treatments, going into 2021. And so it is so hard. We are living by the minute right now on the news cycle, instead of, making sure our investment portfolios are designed for our long term, for years down the road, with our overall risk tolerance. And, we've got people out there listening today, Peter, that no question about it, they don't flat want to lose anything. Yeah. They're done with the stock market. They probably went through 2008 and they went through 2020 here in March and are just done with it.
Well, there are alternatives to that. And I know that we want to talk about that towards the end of the program, or before the end of the program, rather. We will talk about some solutions and alternatives that can help you make forward financial progress, but don't have the risk of the stock market. Now, there's risk in everything, Chris. And so that's sort of where we want to give the background here. When you talk about risk, or you hear the term risk tolerance, those are a little bit ambiguous terms without certain definition, lacking a definite quality to them. How do you help your clients define and quantify risk and or risk tolerance?
Yeah, it's an education process. So if somebody says, I don't want any risk, then where would you put your money? You might think, I'm going to go put it in a CD at the bank. Okay? Well, that comes with inflation risk, right? Because you're basically making nothing. They're protecting your dollars, but giving you nothing in return for it. And if the cost of goods go up by 3% a year, you lose 3% of your purchasing power, right? So what you wanted to spend $100,000 on, to keep the math easy, next year it's going to cost you $103,000. So if your savings account doesn't make $3,000, you've in effect lost 3% of your purchasing power. That's purchasing power risk, or what we call inflation risk. We have interest rate risk. A lot of folks will say, you know what, I want to go from stocks into bonds. I want to get more conservative. Okay, makes perfect sense in times like these, no question about it. But the interest rate risk with investing in bonds is that eventually interest rates will go up, like they did in 2018. The Federal Reserve raised interest rates 4 times. Okay, so by 0.25% every time. That pushes bond values down. So, bond investors can lose money from short-term fluctuations in interest rates. Okay, and for most people that are listening to this show right now, Peter, they don't understand how the bond market works, how the interest rate cycle and all that. They look at where their statement was a month ago to where it is now. And that's fair. We're not being critical there.
Well, and even that, Chris, we open up our statements, we see it in the mail. Oh no, I've heard some bad things on the news. I'm expecting to maybe see a little less money, and we open it up, but it does not readily identify and quantify how much risk we are taking. We can see whether it went maybe up in value or down in value, whatever the case may be from time to time, but it doesn't say, here is how much risk you have. Right in bold red print on the front cover of the statement. But that is, in fact, something that you can help your clients or any investor, saver concerned about their financial future understand and quantify and define with their portfolio, and then figure out and have discussions about more complex issues like interest rates and bond yields.
Correct, Peter, and helping them understand what their money is doing, and I'm going to go back to, the bond discussion. So in 2018, when you open your statements and all of a sudden your bond portfolio or bond positions are down in value, and you own a mutual fund, a bond mutual fund, for example, okay, interest rates went up. And for those of you looking on the podcast, you can see I got my scales going here. Interest rates go up, pushes bond prices down that you already own. Why is that? Because new bonds are coming out at a higher rate than the ones you might currently own. So nobody's going to give you face value for a bond paying a lesser interest rate, when for face value, they can buy a bond with a higher rate. That's not rocket science.
In order to attract somebody to buy your bond from you, i.e. the price of your bond, you have to lower the price to give them an equivalent yield over that duration. It's therefore, Chris, to make it easy, it's a teeter-totter. As interest rates go down, the value of bonds go up, and vice versa, theoretically. But even that hasn't always proven to work out exactly, precisely like science and clockwork, because there have been times where basically all asset classes have gone down.
2018 is a perfect example of that. So, as your bond portfolio was taking a hit in 2018, every bond that matured inside that mutual fund, they replaced it with one paying a higher interest rate. So for those of you that said, oh, I'm going to set sail for greener pastures, okay, you missed out on opportunity. You were buying future higher rates of return. You just don't realize it yet, because most people only care where the market value of their portfolio is on any given day, not the reasoning behind it.
Well, again, if you've got questions, ladies and gentlemen, and you want to go over your portfolio, it's part of the complimentary review process and strategy session there at McIntire Retirement Services. He'll help you understand the risks that you're taking, the fees that you're paying, the taxes that you may be liable for, how to generate the income from the lump sum that you've saved and accumulated to support yourself in retirement. It's all part of the process. Complimentary, no cost, no obligation for this time. You are able to do that in person or virtually through the ease, convenience, and safety of technology, or even if you've just got a direct question, take 10 minutes and get an answer to it. Give Chris McIntire a call, 800-868-1194. That's 800-868-1194, 800-868-1194. Now, Chris, I do want to transition and begin our path towards solutions to these concerns. But before that, I want to, for a moment, talk about the distinction between principal protection and income protection. When we look at the risks associated with either during our working career, we're usually quite comfortable taking risk with our investment, but not so much risk with our income, because that alters our lifestyle and our quality of life. Can you talk about the important difference there between principal and income, and where and when risks to either is appropriate?
Perfect, Peter. Principal protection would be, look, we don't want any market risk. So we're going to look at, kind of the standard banking instruments, checking, savings, money market, CDs, that they offer us principal protection. They don't offer us any sort of income protection. Income protection would be an example of like Social Security, your pension plan from work, if you have one. For those of you that bought an annuity that gives you a guaranteed stream of income that you can turn on at some point in your life, that is income protection. And, we've had Dr. Wade Fowle, David Gaylor, many different expert speakers here on our radio show. And, part of our business in retirement planning is guaranteeing that lifetime paycheck to people. So, we advocate income allocation versus asset allocation as a priority. We want to protect that income because that's what we're going to live off of, and then build a nice investment portfolio around the income plan, if that makes sense, Peter.
Absolutely. But rubber meets the road here, Chris. We're talking about risk, and we're associating this with dollars, with our money. But in reality, when we talk about risk, when we talk about fluctuations in the market, when we talk about the protection for that principal or that income, we're talking about risk to our lifestyle. This is more than money when we're talking about, especially in retirement, Chris, what that risk, what those fluctuations in the market could mean for our quality of life and our confidence in living and spending could mean down the road.
Oh, buddy, and take a look at what stress does. Stress kills. Stress causes cancer. So if you, are getting stressed out about the stock market and, are you going to be able to have enough money to live off of, then maybe your goals aren't aligned with, or maybe your investments aren't aligned with what your goals are. Your goals are, look, I want to reduce the stress level that I deal with. It affects my physiology and it affects my mental aspect. And, nothing is more important than eliminating stress as you get older to help your overall health. And again, guaranteeing that income then can take all the pressure off of your investment portfolio. That, all right, hey, my investment portfolio took a hit. Can I come over here and turn on my safe money and rely on that? I still want to go on vacation. I'm happy that I did that. My safe money clients were the most satisfied clients throughout 2020 because number one, they didn't lose any money on their safe money pieces back in March of 2020. And then when the market goes up, they have the ability to make competitive rates of return compared to other, let's call them safe investments, if you will.
Well, Chris, talk about that paycheck and income. It truly is the foundation, the support system that allows us to make all other further progress. The consistency and reliability of the paycheck is what gives us the ability to do the saving and do the investing. But it seems like we have been taught, and the financial industry promotes us to move away from the importance of the paycheck when we retire. When we are moving away from the paycheck, that's when the financial industry should be promoting replacing that paycheck a little bit more.
Yeah, I think, Peter, it's probably fair to disclose to folks out there that, look, Wall Street wants you to keep money in stocks, bonds, and mutual funds because that's what Wall Street does. And Wall Street is very powerful. Look, and we utilize those instruments. Okay. The insurance industry is not regulated by Wall Street. It's regulated by state departments of insurance. That's where we can devise an income plan and use some of their products that they have created through and are improved by the State Department of Insurance to be marketed to individuals. And some of those are annuities, life insurance, long-term care insurance. And what an annuity can do for someone is take the biggest risk that you have in retirement off the table, and that is longevity risk. The longer your life expectancy is, the greater all the chances of all the other risks affecting your retirement lifestyle are going to happen. That's science. That's not going to make neat headlines or something like that for talks on some of the money shows here where all they talk about is individual stocks. Well, Kramer said this and Miss Bartiromo said that type of thing. You never hear them talk about lifetime income on any of those shows whatsoever because that's typically the boring side of things, right? Stocks are exciting, red arrows, green arrows. Look at the, if the market's going down by 50 points, it's a market sell-off is the headline. I mean, that stuff drives me crazy, to be honest.
But both sides are important here. We're talking about risk and Chris, we've been told in order to get return, in order to get reward, we need to take some risk, and it is part of our financial process. But growth and opportunity must be balanced by security and protection. And so where can we, in an uncertain world, in a volatile market, find that security and protection for our paycheck? I think it's in our cash flow and our budget and in income planning.
Absolutely. So let's think about it this way, Peter. So let's use a big number just so that it's a nice round number. And let's use $1 million just to use a round number. And somebody says, okay, I'm going to draw 4% off of that because I read somewhere where they said I can take off 4% of my nest egg in my retirement and I should be okay. And I was using air quotes. Okay. So that's $40,000 a year, and it takes $1 million to generate that. If you're looking for 4% return, you find some high dividend paying stocks or some bonds and so on and so forth. Okay. You might find that if you used our income allocation model, okay, you don't need all that $1 million to generate that $40,000 of income. So you can have an income plan and then complement it with an investment plan for long-term growth. Because if you're only using the market for that $1 million and that 4% return, and we hit another 20% correction, now you have $800,000. Now you just upped your withdrawal rate to 5%. And Peter and everybody, that all of our associates that we network with, know that the 4% rule is not sustainable. I mean, they've come out and said, look, that was back 1994, guys. This is 2020, and a 10-year treasury bond pays 0.7%. You can't pull,
the guy who
4%.
Came up with the theory has said that himself.
Yeah, Mr. Bengen, I believe is how we pronounce it. Yep.
Chris, you've talked about this mathematical equation on the program before as equivalent portfolio value. And this is something that you go through in helping somebody determine if they should take a pension as a lump sum or if they should, in fact, take the lifetime income that it is capable of providing. And when and how they should claim and collect Social Security is also part of the equivalent portfolio value kind of equation.
Absolutely. And those things are key components in building an overall retirement plan. So we do retirement planning, not just investment planning. So part of our overall plan is, okay, let's look at the big picture here. When does Mrs. Jones take her Social Security benefit? How does Mr. Jones choose to take his pension? Does he take it from the company or does he roll it into something else? Again, to generate some income? Do we do some 401k rollovers? Do we look at Roth IRA conversions as they're going through so that they can pass more money on to their beneficiaries or to themselves income tax free? So a retirement plan takes so much other things into consideration versus, hey, what are the hot stocks of the month? I mean, most of you folks can log into the Motley Fool or something like that and try to pick, be a do-it-yourselfer if you want to, but that doesn't always work out because it's hard to hold yourself accountable.
No, those are oftentimes options that inherently do hold a lot of risk, which again, today on the program, we're identifying risk, we're quantifying risk, and we're looking for solutions to help us feel better about the risk, or solutions that offer a little bit more security and protection. And if you'd like to look at all aspects of your plan and all options that are available, give McIntire Retirement Services a call, 800-868-1194. You can go online, McIntyreRetirementServices.com. Again, give Chris a call if you'd like that complimentary review, a detailed forensic look into your financial picture, looking at all aspects of your planning in person or virtually with the ease, convenience, and safety of technology. Go online, McIntyre Retirement Services, or give a call, 800-868-1194. Even if you have got a specific direct question, you just want to get an answer, take 10 minutes and get that answer, get your question addressed, 800-868-1194. So again, Chris, as we are looking at balancing the risks that are going to be inevitable in the financial world, certain products, certain strategies offer protection specifically for principal or income. You've got products that offer a guaranteed income for a lifetime, which really isn't available in a Wall Street driven product.
You're correct there, Peter. And even some of these accounts that we use have the ability to give you a potentially increasing income over your lifetime. So we get rid of longevity and we can hedge the inflation risk. We can take care of the market risk as well. So, some of these things we can kill a couple of birds with one stone, okay? And they complement an overall investment plan. So Peter, this is where our niche is, obviously, is, we're not completely unbiased on Wall Street. We're not completely unbiased on the insurance industry or the banking industry. We know all these places have a key factor in building a successful retirement plan, whether we're dealing with a widow person, a married couple, younger clients, older clients. Everybody can adjust over time. And I guess that's why we like, our fiduciary responsibility, our independence to help people recognize and make difficult decisions through our education-based process.
And Chris, you said it, you're not just investment planning, you are financial and retirement planning. And really, I think that's the key to addressing this question of risk, is having that plan in place is the apex, most important part of how you can cope with, address, and navigate the risks that you are taking.
Peter, I would say that if I'm dealing with a client here, generically speaking, guys, so bear with me here, and let's say I got a married couple that come in and they've got $400,000 or $500,000 in 401ks. Taxes probably aren't their big problem. Okay. If I've got somebody that comes in who's been quite successful and has a $2 million 401k IRA plan, okay, might not be as worried about them running out of money as I am controlling the tax situation. And again, not eliminating it, controlling it, because if you put all your money into IRAs and 401ks, you're not going to eliminate taxes, but can you efficiently manage the process and talk about Roth IRA conversions, cash value life insurance that can have a long-term care benefit on it as well. Again, can we kill a couple of birds with one stone, so to speak?
Yeah, well, I think that, Chris, risk is something that we're going to deal with, but most of us put it in the back of our mind until it is oftentimes quickly, suddenly, and unpleasantly brought to the surface. And that's what we see, is that the market takes its time gaining and giving us progress, but it quickly can erase them. And that's when people realize how much risk they are taking and realize that they are potentially uncomfortable with that risk. But that's why having that plan in place is so important. That's what you help people really design and implement and then measure along the way and continue to monitor along with them.
Absolutely, Peter. And I'll share a quick story with everybody out there. This is about the 2-year anniversary of my wife having a pancreatic tumor removed. And we cheated a certain death. Thankfully, we did some planning before that. But I'm telling you guys, it can happen. A phone call can change your life. You need to have a plan in place. Do not be reactive. Be proactive. You'll be much better off. That's from the heart.
Chris McIntire there to help you be proactive with your financial life. Pick up the phone, give a call. Risks and protections, opportunity for growth and security, they all must be in balance. The plan is what helps you arrive at that proper balance for you. And it's going to change over time. Chris can help you design a plan, execute and implement the plan, and then continue to monitor and update the plan throughout all the years to come. He is a true comprehensive planner with that fiduciary responsibility. Pick up the phone and give him a call, 800-868-1194. That's 800-868-1194. And Chris, we always appreciate your time here on the program.
It's good to be with everybody. Stay safe and do the things you need to do, guys.
Visit McIntyreRetirementServices.com for many additional valuable resources, including other great episodes of Game Plan for Retirement with Chris McIntire. Be sure to subscribe.
The content of this radio show is provided for informational purposes only and is not a solicitation or recommendation of any investment strategy. You are encouraged to seek investment, tax, or legal advice from an independent professional advisor. Any investments and/or investment strategies mentioned involve risk, including the possible loss of principal. Advisory services offered through Brookstone Capital Management, a registered investment advisor.
Fiduciary duty extends solely to investment advisory advice and does not extend to other activities such as insurance or broker-dealer services. Advisory clients are charged a quarterly fee for assets under management, while insurance products pay a commission, which may result in a conflict of interest regarding compensation.
Any comments regarding safe and secure investments and guaranteed income streams refer only to fixed insurance products. They do not refer in any way to securities or investment advisory products. Indexed or fixed annuities are not designed for short-term investments and may be subject to caps, restrictions, fees, and surrender charges as described in the annuity contract.